Italy is facing an economic crisis as its national debt is shooting through the roof with far-reaching consequences. For all of Europe, Italy is suffering from one of the worst economic crises that brought down the GDP to an all-time low. So today, we'll break down Italy's challenging economic conditions, their population problem, their debt crisis, and whether or not there's still any hope for Italy. Starting with Italy's horrible numbers. Italy is facing a crisis that looks like the one Greece had in 2010. The country is facing debt, not enough working-age people, and a touch of political drama. It's like watching a similar movie but with different actors. But let's talk numbers. Italy is carrying a boatload of debt, both public and private, totaling over 330% of its GDP. That's a lot. Now, experts say that when this debt to GDP ratio goes over 300%, the economy tends to take a hit, and Italy crossed that line around 2010. Since then, it's been a bit of a downhill ride for their economic growth. Back in the 70s and 80s, Italy had a booming economy, growing between 3 and 5% on average. But the economy took a big hit in 2010 when the GDP per capita started to shrink because of negative growth. This has been going on for more than 10 years, and Italy can't sustain this for much longer. When life gets tougher for people, it often leads to problems in the government, and Italy is going through some of that too. There are a bunch of issues because prices for things are going up a lot, and that's making it harder for people to buy what they need. Prime Minister Mario Draghi also threw in the towel in July 2022, tried to resign, got rejected, and then resigned again after a no-confidence vote. Which brings us to the population problem. The truth is that Italy is running out of people, and an economy needs people in the 15 to 64 age range because these are the people who work, spend money, and pay taxes. But Italy's working age population is shrinking fast. Since 2012, there's been a flip from positive to negative growth in this age group, and that's a huge red flag for the economy. The future doesn't look bright. Italy is on track to have worse demographics than Japan, which has been the poster child for bad demographics. While the United States isn't winning any prizes for demographics either, it is doing better as compared to the rest of the world. The interesting thing is that there's a connection between all this debt and the population decline that many experts don't talk about. As debt goes up, economic growth goes down, like a weight dragging the economy. This affects young people trying to kickstart their careers, buy homes, and start families. Thanks to massive amounts of debt all around the world, families are putting off having kids, and it's causing a big problem with the population. Italy's crisis is like a perfect storm of excessive debt, political chaos, and a shrinking standard of living. But at the heart of it all is a population problem that's only getting worse. Financial markets know Italy can't pay up, and the European Central Bank is trying its best to prevent Italy from defaulting. But without enough working-age people, there's not enough tax money to pay off the debts. Could this be a repeat of the Greek debt crisis? Well, let's talk about Italy's economic situation using a famous saying from Herb Stein: if something can't go on forever, it'll stop. That's pretty much the story when it comes to Italy's knack for piling up more and more debt to cover its budget gaps. It might be time for that to stop, especially since Italy doesn't seem keen on shrinking its giant debt anytime soon. The world cannot really afford a situation where Italy has money problems because it could mess up the whole world economy. Italy's economy is way bigger than Greece's. Think 10 times bigger. We all remember how the Greek debt crisis shook things up. Well, imagine the impact of an Italian debt crisis today. So why are we thinking another Italian debt crisis is on the horizon? Well, all the things that could help Italy shrink its debt are heading in the wrong direction. From Italy's current debt to GDP ratio being 145% to a solid 20 points higher than during the 2012 Italian debt crisis, things aren't looking too good. There are 3 things that could help: a healthy budget surplus, lower interest rates on loans, and a faster growing economy. But Italy is going the opposite way on all 3 fronts. Instead of a budget surplus, Italy's budget proposal suggests huge deficits. The European Central Bank is tightening its rules as well, and the interest rates on Italy's government bonds are skyrocketing because of this. As for economic growth, Italy seems headed for another downturn, partly thanks to the fallout from the ECB's moves to keep inflation in check. That's not great news when Italy's growth record has been slow since it adopted the euro area in 1999. Before, Italy didn't sweat too much about getting loans at good rates because the ECB had its back, covering most of its borrowing needs. But in July 2023, the ECB slammed the brakes on buying bonds, and Italy is relying more on the financial markets to cough up the cash it needs now. It's important for the government to make investors feel comfortable during a time like this, but the Meloni government's promises haven't quite hit the mark. They tried this tax on bank profits, and their budget is forecasting a 5.3% deficit, which isn't making the European Commission very happy. Lately, people are paying a lot of attention to Italy's money situation, and it's causing a bit of a stir in the markets. The difference between how much Italy and Germany have to pay on their government loans is the highest it's been all year. The market is now begging the country to change its economic game plan soon if it wants to prevent a full-blown debt crisis on its hands next year. The shrinking economy isn't helping either. Italy's economy hit a bit of a roadblock in the second quarter, and it threw a curveball into Prime Minister Giorgia Meloni's plans to keep things in order and tackle the country's debt. The GDP took a dip of 0.3% compared to the first quarter, which was worse than what the experts predicted. They were thinking Italy would at least break even, but it didn't go that way. This happened while other countries in the euro region were still managing to expand. What caused this economic slowdown? Well, it seems the Italian buying power has diminished, and the money from exports hasn't really helped pick up the slack. Industries in agriculture also felt the pinch. Now, the International Monetary Fund is saying that Italy's GDP will only grow by 1.1% this year, which isn't the kind of news they wanted to hear. But Italy's finance minister is still optimistic. This is because of the alleged growth spurt of 1.4% in 2023, thanks to a tourism boom. While that might have given Italy a small boost in the second quarter, there's a global slowdown in manufacturing hitting Italy, just like the one affecting Germany. In June, Italian factories had their worst month since the crazy times of the pandemic lockdowns in 2020. But let's not forget the bigger picture. The Eurozone saw a 0.3% growth in the second quarter, and France and Spain were growing, while Germany was in neutral, and Italy, unfortunately, was running in reverse. There's a lot happening globally, from the Israel-Palestine war to a shaky export market, especially in China. And to add some more uncertainty, the European Central Bank is going at it with new monetary policies and higher interest rates. It's unclear if they're going to pull another move and raise interest rates at the end of 2023 because we're not sure if Italy can handle that right now. But it all depends on how bad inflation is, and inflation in the euro area was unexpectedly strong at 5.5% in July, with the main inflation number slowed down to 5.3%. Italy's was a bit slower than expected at 6.4%. The next step seems to be reduced public spending. Italy's economy minister thinks keeping a tight leash on public spending is the right move, especially since the European Union is bringing back strict rules next year. Right now, EU countries are talking about tweaking these rules, and Italy is suggesting ways to make them a bit more lenient. But Minister Giancarlo Giorgetti wants everyone to know that some tough decisions are on the horizon. Giorgetti also pointed out that Italy's biggest challenge is handling its public debt. After all, it's up there, second only to Greece, and it's expected to be around 139.6% of the country's GDP in 2026. A little down from the 140.2% expected this year, however, it's not a small percentage by any means. But there is an ambitious plan. Italy is looking at around $22.22 billion from selling off assets over the next 3 years. This move aims to keep the debt from climbing even higher. Giorgetti hinted that this might involve selling a bailed-out bank called Monte dei Paschi di Siena, and maybe even some public infrastructure. This is on top of a huge tax cut incoming in 2024. Italy's government greenlit a budget for the next year. It will feature measures totaling about $25.3 billion in tax cuts and increased spending. The plan includes raising next year's budget deficit to 4.3% of the GDP, up from the current trend of 3.6%. But this shift also involves an extra $16.5 billion in borrowing, primarily allocated to fund tax cuts. Prime Minister Giorgia Meloni described the budget as very serious and very realistic during a press conference. Economy Minister Giancarlo Giorgetti showed confidence that it would be well received by both the markets and EU authorities. However, investors got worried when Italy said they needed more money than planned. They asked for extra money in return to lending to Italy. The difference between Italy's loans and Germany's loans stayed about the same, just a bit more than 2%. So even though some were worried, it didn't change much after Italy's budget got approved. With the issues in Ukraine and problems in the Middle East that seem to be getting worse, can the new budget help fix the struggling Italian economy? Let us know in the comments section below. Thanks for watching, and we'll see you again soon. Make sure to watch the next video.